Hello everyone. Today we are going to discuss two cases from Chapter 11. Opening case, the Murdochs versus minority shareholders, and the closing case, the private equity challenge.
News Corporation was founded in 1980 in Adelaide, Australia by Rupert and moved to New York in 2004. It switched from New York Stock Exchange to National Association of Securities Dealers Automated Quotations as its principal listing in 2008, with a secondary listing on the Australian Security Exchange. While News Corporation unethically behaved in its British tabloid operations, shocked the world in 2011. It wasn't the first time the company, which thrived on reporting on other people's issues, created its own. The treatment of minority shareholders by controlling shareholders, Rupert and his family, has been a recurring issue of controversy. In 2003, James Murdoch, then 30 years old, took over as CEO of Sky, Europe's largest satellite broadcaster, despite furious opposition from minority shareholders. And why it happened? Because Rupert Murdoch was his father, and who owned 35% share of Sky stock and sat on the board of directors. Another case, in 2007, Rupert Murdoch pursued a pet project by paying a hefty $5.6 billion to buy Dow Jones, the Wall Street Journal's publisher. Contrary to the concerns of numerous minority shareholders and recommendation of Peter, News Corporation's president and a non-family member, News Corporation wrote down its worth by $2.8 billion after 4 months. Meanwhile, in 2009, Peter left the company. In 2011, News Corporation stated that it will pay $673 million for Shine Group, a London-based media company owned by Rupert's daughter, Elizabeth Murdoch, in a linked transaction. While Shine produced blockbuster shows including NBC's The Office and The Biggest Loser, minority owners claimed that News Corporation overpaid for the company by 13 times. Shine had a profit before interest, taxes, depreciation, and amortization of $46 million. CKX, the owner of the popular show American Idol, was purchased for $510 million by Apollo Global Management, a major private equity firm, in a deal valued at 8.5 times CKX $60 million in EBITDA. Minority shareholders, including Amalgamated Bank and other pension funds, sued to stop the transaction in Delaware, where the News Corporation was registered. Murdoch did not even pretend that there was a viable strategic objective for News Corporation to buy Shine. According to the complaint, and the acquisition is a transparent and selfish endeavor by Murdoch to further infuse the highest level of News Corporation with his offsprings. Amalgamated Bank and News Corporation reached a $139 million settlement in 2013. The Economist has appointed Rupert Murdoch the last of the Mughals. According to Michael Wolff, author of Rupert Murdoch's biography, The Man Who Owns the News, no one could say no to Rupert Murdoch. As a result, the stock performance of News Corporation lagged behind that of its competitors, such as Walt Disney. There's just this generic Murdoch discount, which incorporates the concern that he will make judgments that are inconsistent with the other shareholders' interest.
Continuing with the history of the Murdochs, Rupert Murdoch, the patriarch of the family, inherited his empire from his father, a chain of Australian newspaper. Murdoch's father was a war reporter who turned publisher in 1952. At that time, Murdoch was only 22 years old and had just graduated from Oxford University. To gain success, Rupert included scandalous stories in his paper, which really helped his sales. The early success allowed him to expand quickly. Rupert Murdoch started Australia's first nationwide newspaper, The Australian, in 1964. By 1970s, he was purchasing titles like the UK's News of the World and The Sun. He founded Fox News in 1996. Publishing salacious content was a strategy. Years later, his English newspaper holdings were embroiling in a major voicemail hacking scandal, earning him the nickname the Dirty Digger from the satirical news show Private Eye. Murdoch's name is synonym for media and influence. He built an empire comprising Fox News, The Wall Street Journal, The Times of London, and other networks and newspapers around the world. Murdoch is father of six children from his four marriages. In 2013, when Rupert split News Corporation into two, 21st Century Fox or 21CF, which focused on film and television operations, and the new News Corp, which focused on mass media and publishing. In 2019, 21st Century Fox was sold to Walt Disney for $71.3 billion, netting $12 billion, which was distributed equally between Rupert's six children. For News Corp, Rupert and his both sons serve as co-chairmen for the board of directors, and other son as the another director. But down the road, James, one of his sons, left the company due to some disputes. To understand the issues of the case, it is important to understand corporate governance. According to text, corporate governance can be defined as the relationship among various participants in determining the direction and performance of corporations. There are three primary participants in corporate governance: owners, managers, and the board of directors. Owners, they provide capital, bear risk, and own the firm. As per the text, there are three broad patterns in ownership: concentrated versus diffused ownership. Concentrated ownership and control is where founder starts up the firm, owns it completely, and controls it. Diffused ownership is an ownership pattern involving numerous small shareholders. Among them, none of them has a dominant level of control. Family ownership: the ownership and control of the firm is within the family. The vast majority of large firms throughout continental Europe, Asia, Latin America, and Africa features concentrated family ownership and control. At present, 85% of firms in Southeast Asia are family owned, 75% in Latin America, 67% in India, and 40% in China, where 40% in Europe and 15% in US are family owned. There's another ownership called state ownership. These are the state-owned enterprises or SOEs, which are controlled by government. These enterprises often perform poorly. In theory, all citizens, including employees or owners, but they barely owns or have any benefits or have any rights to get benefits from the firms. But in this case, the News Corporation is a family owned company ever since. As discussed in previous slides, business built by a father is passed on to the son, and till today, the next generations run the show.
Hi, this is Simran Ahir. Now I will continue this case study. The primary problem of the case is collusion. Now, what is collusion? Collusion is a non competitive, secret, and sometimes illegal agreement between rivals which attempt to disrupt the market's equilibrium. The act of collusion involves people or companies which would typically compete against one another by who conspires to work together for gain and unfair market advantages. The entities of individuals work together to manipulate a market or pricing for their personal gain. This is known as collusion. Price fixing, synchronized advertising, and exchanging insider informations are examples of collusion. Collusion is discouraged by antitrust and whistleblower laws. Rupert Murdoch and her family have a history of continuous behavior at the expense of smaller shareholders as controlling shareholders of News Corporation. Collusion is the term used to describe these acts. Now, when and how does this collusion happens? Collusion happens when rival companies that would otherwise not work together agrees to cooperate for their mutual advantages. This is referred as to collaboration. For example, the companies may agree to refrain from engaging in a previously agreed upon activities in order to limit competition and increase profits. Collusive behavior are widespread in the market structure like an oligopoly, a market structure where small number of sellers dominate the market. Since there are few significant players, the relationship between oligopolies and collusion can also work in the opposite direction. Collusion can lead to the formation of an oligopoly. Collusive acts inside the structure can have a substantial impact on the market as a whole, starting with a reduction in competition and subsequently the potential prospect of higher consumer prices. Acts of collusion that result in price fixing, bid rigging, or market allocation could put organizations at the risk of the beginning of prospected of for antitrust breaches under the Federal Cartel Antitrust Act. The Cartel Antitrust Act, enacted in 1914, is designed to prohibit monopolies and protect customers from unfair commercial practices. While collusion is most commonly associated with hidden deals made behind closed doors, it can also occur in a variety of scenarios. For example, cartels are one of a kind example of explicit collaborations. The explicit and formal structure of the organization distinguish it from collusion in the usual sense. Private and public cartels are occasionally distinguished, with the latter referring to a cartel in which a government is involved and whose sovereignty principles protect it from legal actions. In an oligopoly where there are few suppliers and little competition, each seller is likely to be intensely aware of the competition's behavior. This usually results in a system in which the activities of other industry actors greatly influence and are influenced by the decision of one firm. When collusion is involved, these impacts usually take the form of secret agreements that cost the market the low prices and effectively that competition independence would otherwise favor. On the other hand, there are antitrust regulations that have become common around the world. Another type of collaboration is tactic collusion, which refers to collusive behavior that aren't visible. The tactic collusion occurs when two companies agree to follow a specific strategy without saying so directly. This can be illegal also.
Text also explains about the conflicts occur in the companies. To understand the conflicts, we should comprehend what agency relationship is. The relationship between shareholders and professional managers is the relationship between principals and the agents, in which principals are the owners and the agents are the managers. It is called agency relationship. As per above discussion, there are two types of conflicts. Principal-agent conflict. It is a conflict in which there is a difference in the interests of the principals and agents. These conflicts can lead to agency cost, which is principals' cost of monitoring and controlling agents, and agents' costs of bonding. Second conflict is principal and principal conflict. It is a conflict which occurs when there is a conflict of interest between two classes of principals, controlling and minority shareholders. The Murdochs is a clear example of principal-principal conflict, where family managers, the Murdochs or the controlling shareholders, may indulge in a cronyism and advance family interests, ignoring the interests of minority shareholders.
Closing case, the private equity challenge. If you grab the Burger King for lunch, did some shopping at Neiman Marcus, munch at Outback Steakhouse for dinner, enjoy the Budweiser, check into a eating hotel, take a ride on an elevator made by Turks Group, turned on a Dell computer, you never left the world of private equity. Private equity is one of the hottest and most controversial buzzwords in the corporate government. Private equity first emerged in the 1980s with a stream of deals pepped by Colbert Roberts of $25 billion takeover of the RJR Nabiscos in 1988. After the RJR Nabiscos deal, the private equity industry stagnated during the 1990s. In 2000s, private equity rose again. In 1991, just 57 private equity firms existed, close to 700 chased deals. It is now a $3 million industry with more than 3,500 firms. There is almost more than $1 trillion dry power on spent cash for deals. Private equity deals now represent 25% of the merged and acquisitions. Controversially, private equity is a response to the corporate government deficiency of the public firms. The pre-value equity excels in four ways: private ownership, unlike disparate individual shareholders, care deeply about the returns on investment. A high level of debt imposes strong financial discipline to minimize waste. Private equity turns managers from agents to principals, with substantial equity in brackets, typically 5% of equity to the CEOs and 16% of the whole top management teams. Private firms make the same managers managing the same asset perform much more efficiently. On average, there is a 2% boost in the productivity and efficiency. Privacy is fabulous because for manager, there is no more short-term burdens to meet the numbers every quarter for Wall Street. No more burdensome paperwork for regulation and especially crushing loads thanks to the sock and dog frack laws. Also, no more disclosure in excruciating details of their pay, which is an inevitable invitation labeled as the fat cat. Unsurprisingly, managers prefer a quieter but a far more lucrative life. In the 1997, more than 8,000 firms were listed in the US stock exchange. In 2017, thanks to the private equity, only more than 4,400 but are to be listed. Other than barbarians, according to critics, private firms have been labeled as asset strippers and locusts. A high percentage at the public firms has already become a huge controversy. Private equity has further increased the income inequality between high financials and top managers, as the top 1% and the rest of the 99%. Inherently, private equity has rapidly proliferated within emerging economies such as China, South Korea, and the United Arab Emirates, as well as developed countries in Europe. In the largest private equity deals in Germany, ThyssenKrupp sold its elevator division to Ardent International and Civet for a whopping $19 billion in 2020. Well, Germany has recently become the most and the popular European destination for private equity deals, reaching an all-time high of $32 billion in 2019. In summary, while private equity is under attack for destroying jobs, its real problem is that returns on investors are low. With so many private equity firms with dry power chasing a limited numbers of water deals, the returns are likely to be fabulous. Now that four of the leading players, which you already know, have become publicly listed, well, they may become less glamorous and more boring. The middle-aged corporations struggling to deliver better returns to their investors.
Hey everyone, today I shall be speaking about a Canadian firm's perspective for two cases. The first case traces the career of an influential businessman, Rupert Murdoch. One of the last surviving moguls, Rupert Murdoch was a fierce businessman who controlled complete companies with his and his family's collective majority shareholder stake. They controlled all decisions made by companies and would do business in complete self-interest without considering the wishes or opinions of the rest of the minority shareholders. His influence was over people as he swayed many with his power and dominance, which made him a very hard person to say no to. Murdoch's actions were undermining the power and importance of minority shareholders, as they were neither consulted nor were they properly briefed about the decisions made by the majority shareholders. Minority shareholders didn't feel valued in the company and felt as if they were only along for the ride with the Murdochs as they used their money to make themselves richer. Rupert Murdoch usually exercised his power by letting personal relationships affect his business decisions. In this case, his position at three separate firms is evaluated. Rupert Murdoch controls 35% of Sky Corp's equity and he appoints his son James as CEO. Murdoch paid $6.5 billion to buy Dow Jones. 4 months after acquiring Dow Jones, News Corporation writes down its value by $2.8 billion. Murdoch also wanted to pay $673 million to acquire his daughter's media company, the Shine Group. The minority shareholders claimed that the acquisition had no substance or vision to grow shareholder profit and provided estimates showing Murdochs had overpaid for Shine by 13 times. These events transpired into a lawsuit that was settled for $139 million. In 2013, News Corp News Corporation was split into 21st Century Fox for film and media and News Corp for news and information. At 21st Century Fox, he appoints himself as chairman and CEO and appointed his sons as co-chairman and co-CEO. Walt Disney later acquired 21st Century Fox for $71 billion in 2019. From a Canadian firm's perspective, protective laws have been established by Canada Business Corporations Act that aid minority shareholders build cases against unlawful practices by majority shareholders. A board of directors can be voted out of the company if a majority vote is cast against them, meaning no member of the firm is safe from termination and the company can and will continue on without them. The CBCA also sets standards for ethical guidelines and practices for decision making. As the board of directors all have a personal stake and share in the company, they share the gains and losses together. This means there should be no immoral meddling with the company's financial resources, which is essential for all levels of business, regardless of minority shareholder or employee. To reduce such possibilities, the CBCA have announced new provisions and updates to the shareholder equity on July 1st, 2021. There will now be A. Annual board elections, B. Individual voting, C. Majority voting, and D. The shareholders will no longer be allowed to will now be allowed to vote against or for each nominee. These changes allot one vote to majority vote and reduces majority vote influence. The Government of Canada hopes that these changes will make voting of each shareholders more valuable and influential in decision making. In the second case, we talk about the private equity challenge. Private equity firms are often taking underperforming publicly listed firms off the stock exchange and inject the company with a huge amount of debt. The company is then trimmed off by layoffs and other cost-saving techniques. These financials of the private equity firm are now bloated due to the aforementioned adjustments made by the owner. The profit is earned when the public, when this company, with skewed financials, goes public again on the stock exchange with a new initial public offering (IPO). The private equity industry is currently at a $3 trillion total and is still growing. Private equity is a response to the corporate government deficiency of the public firm. Private equity excels in four ways. Firstly, private owners are far more invested in the company's future and their return on investment as opposed to individual shareholders of the company. Private equity firms also send experts to sit on the board and are hands-on managing. Secondly, a high level of debt imposes strong financial discipline to minimize waste. Next, private equity firms pays more generously but also punish failure more severely. Finally, private equity is recorded to improve managerial and asset performance, which estimates to a total 2% boost in productivity and efficiency. Private equity does lead to income inequality growth and job cuts due to layoffs by about 1 to 2% annually, but the same would have happened if the companies had remained public, and public firms are not less harmful than a private equity firm. In Canada, the Canada Venture Capital and Private Equity Association research and advocate the importance of private equity to the economic development. As a Canadian firm, I believe it to be a viable dire strategy to turn the financial return around of an underperforming firm to make it profitable again. These are tough choices and decisions in the ethics of private equity. However, financially it is a solid strategy, and as a manager of a public Canadian firm who is trying to maximize profit and salvage the use of the company, this could be a very useful option to have.